Good evening, everyone. Time for this week's silver update. We had quite a surprising day today. We powered quite a bit higher, nearly to 41, and I wanted to point a couple things out. First off, a number of people have asked me when I was explaining the MACD what I mean when I'm talking about a crossover. A crossover is where this red line crosses this blue line, or where the blue line crosses the red line. Either way, when you see these lines cross, if you look down at this baseline, you'll see it go from positive to negative, or I'm sorry, negative to positive, or positive to negative. So they always correspond. Let's get a closer view so you can see it. Actually, we'll go to the tick view. So you can see right here we had a cross. That corresponds exactly with the move below this line into negative territory. When we go up and cross into positive territory with these bars, you get a cross of those lines. So those always correspond with each other. Now, back to the chart we were looking at, I was pointing out that I was expecting a pullback to 38, 37, or 31 if this MACD rolled over down, this cross right there, if it rolled over and did this, this, or this. And as I pointed out, it seemed to be rounding up, and it did. What it did today is it crossed over to the upside, right there, that positive cross, and I was pointing out my concern that it would actually roll over and cross up before it went back to the zero line. Now, what is this zero line? What is this zero line reference when it's talking about these lines coming back down here? Well, when the lines are here, such as here or here, then they're at a zero state of overbought and oversold. So what occurred last night and today is that the MACD on the 2 hour was rolling over to the downside and approaching a neutral condition, or possibly oversold condition like this one. But what happened was, while it was in a relatively overbought position, it rolled over to the upside and crossed up. And you can see the strength here in the market. In the series of trend lines I've drawn, we're starting to go parabolic on this. So it's not guaranteed. We can't predict with certainty, otherwise we'd all be billionaires, and we know that's not possible. So another thing I wanted to point out is that I had drawn a trend line of these tops in the MACD, and you'll notice that we turned around, failed to fall to the zero line, and crossed over and actually broke out of this MACD trend line. So we've got a series of rising faster trend lines, and we have a breakout through a falling trend line on the MACD. So we're entering strange times, and we're going to have to wait and see. We could actually make a very rapid run to 50 and just kind of blow through 40. Now, I wanted to return to one of the issues I was talking about yesterday, and we'll just go back and look at Netflix, since that's the one we were looking at. This table here is a table of the major holders of Netflix stock. Now you can see, first of all, that the percentage of shares held by institutional and mutual fund owners, or we should really look at the percentage of float, which is the float is the available stock that the public can buy. The percentage held by institutional and mutual fund owners is 90% of this stock. and that's 454 institutions. So The vast majority of the owners of this stock are institutions and mutual funds. Now, we have a breakdown here. You've got FMR controls, that's Fidelity, controls 8% of the outstanding shares of that stock, 4 million or so shares. And then Morgan Stanley, Vanguard. These are the two big mutual fund groups. These are the ones you most likely find in your 401k, Fidelity and Vanguard. So why am I bringing this up? Well, I wanted to address the issue of diversity, because if you listen to any of the financial shows, they will tell you, to a man, in fact, that you need to diversify. You need to make sure that your holdings are diverse, and it goes back to just common sense. Don't keep all your eggs in one basket. But I wanted to show you how, when we examine gaming and odds theory, that this is actually a losing proposition, and ultimately a guaranteed losing proposition. So let's look at some gambling. We've got a lot of casinos. This is a Luxor. I believe this is a Luxor in Vegas. Very wealthy. There's a ton of wealthy casinos in Vegas, and all around the world, in fact, in the Bahamas, in Monte Carlo, and all over the world. So obviously these people are making tremendous wealth, and the question is how. Now, if we look at these floors, I'm sure a lot of you are familiar with these floors of slot machines where people put in their nickel or their dollar or whatever it is and pull the slot, and they play game after game after game. So I wanted to examine gaming and odds theory so that you could understand how that applies to casinos and how they make their money. And ultimately, the biggest casino, of course, is Wall Street. So let's look at a little bit of gaming theory here. This tool here is called the Kelly calculator. It's just one I found out on the internet. There are tons of calculators you can find, but this one had the sorts of features I was looking for. What I was looking for is a calculator that would allow me to calculate a large number of bets based on a certain probability. So let me outline first what I'm getting at. Is you have in gambling what is called the edge, which is right here. An edge is something better than 50%. So the way that these places built these gigantic structures is through an edge. These people that own this have an edge over the people that come there. These people. And the way the edge works is, betting theory tells you that, and this is the essence of betting theory, that depending on who has the edge, the number of bets will be optimal. So what that means is, this woman sitting here, this machine has the edge against her. She does not have the edge. Now, there are some blackjack players who count cards, and there are some baccarat players, etc., who actually have an edge if they do everything correctly. So if you're in a situation where you do not have the edge, such as this woman right here, the optimal number of bets is 1. So her best odds of winning, her best odds of leaving this place with a profit, is to go to the highest priced slot machine and pull it one time and then stop. She has roughly a 50% chance of winning and a 50% chance of losing. That's her best bet when she doesn't have the edge. Now, if she has the edge, of course, then she wants to do an infinite amount of bets to make that so. This is a situation where the house has the edge, so it is in the house's interest for you to make an infinite number of bets. So the more times this woman pulls this slot, the less chance she has of walking away with a profit. So let's look at the odds calculator and show how that works. This calculator is set to 1 bet. The edge is 50%, so it's an even bet. So the expected profit is 50%. You're either going to win or lose. So let's play with these numbers a bit. Let's take the number of bets up to, say, 999. And let's give you an edge of just 1%. And then calculate. So we're going to make 999 bets with a 1% edge. And you could see we started out with a bankroll of 1,000, and the expected bankroll, that, well, we have 1% profit growth. That didn't work out so well, so we're going to change this to less than that. Let's try a smaller edge, such as 0.01% at 999, and calculate the edge. Okay, so that's something went crazy with the calculator. Anyway, if you did 999 bets with a 0.01% edge, then your expected profit is 0.0013%. You'd actually make 101 point something percent. So if you had $1,000, you're going to end up with 1%, a $10 profit. So that seems crazy that after 999 bets you'd only have 10 bucks on 1,000. But let's bump up the number of trials and put it up to a lot of 9s and calculate again, and you can see we've got, well, that's too many because it broke the calculator. So let's back off 1 or 2. Okay, so now you can see our number is 349%. So with just a 0.01% edge. Okay, so if you understand blackjack, for example, if you're betting on blackjack, if you bet exactly right strategy and you count cards, and most of the blackjack teams use this strategy, is they increase the number of players on the team and they all pool everything, and that increases their number of bets when they have an edge if they play correctly. So here we've made 100,000 bets with a 0.01% edge, but our starting bankroll is now $3,500. So we made ourselves $2,500. That's with a tiny edge. So you see the point that the whole key is who has the edge. If the house has the edge against you, your best bet is 1 bet. If you have even the tiniest edge against the house, your best bet is an infinite number of bets. So the house is banking on you pulling that slot an infinite number of times because they have the edge. And if you're on a blackjack team, you're trying to get as many bets in to take advantage of that edge. So let's take that back to Wall Street and diversification. So most people who own 401ks, they don't own these stocks directly, such as Netflix. They own Fidelity. So Fidelity has a management fee that they charge. And then, as we showed yesterday, Netflix actually has fees built in, which is these insiders taking their cut and depreciating the profits of the company. So you're back 2 steps from these profits. Now imagine if the mutual fund that you hold owns, say, 100 of these sorts of companies. You don't have the edge. Wall Street has the edge. In fact, they have the edge twice. They have it with their dilution of your value through these insiders and through the management fees charged by these mutual funds. So each time they're taking a cut, twice they're taking a cut, times 100, or however many companies you own. So the point is that Wall Street is really very much like these casinos. As you diversify your holdings and make a very large number of bets, because they have an incremental edge, you are guaranteed to lose, and they are guaranteed to win. Now, on the other hand, if you have a bet where you know you're right, in fact, this is a 100% bet, because if you study silver enough, you'll know that you're right, and you can't be wrong. So you have one bet, and that bet is physical silver. And the only question remains is, how much can you accumulate? And that's where you use these indicators to give you your buy signals to get in, to get as much physical silver as you can before this thing, which has a 100% chance of going up, goes up. So you want to not waste your money giving it to Wall Street casinos, and you want to invest your money, and it will pay off very high dividends if you invest in real money. And we'll talk to you next time.